Imagine a tax strategy that lets you pull money out of your business completely tax-free. Sounds impossible, right? Well, one Canadian company just did it, and today, I'll show you exactly how. Welcome back, everyone. I'm Rozdeba, CEO of Dundas Life. As a trusted insurance advisor in Canada, I've been committed to making life insurance more accessible and empowering you with the knowledge you need to achieve your financial goals. Today, we're talking about the Capital Dividend Account, or CDA, a powerful yet often misunderstood financial tool designed specifically for Canadian business owners. Whether you own a small family business, a growing enterprise, or planning your business succession strategy, understanding CDAs is crucial. We'll break down what a CDA is, how it works, and most importantly, how you can take advantage of it. Before we dive in, don't forget to like and subscribe our channel for more content like this. Now, let's discover how the CDA can benefit your business and help you achieve your financial goals. So what exactly is a capital dividend account? Simply put, the CDA is a special rule in the Canadian tax system that allows private corporations to pay a certain dividend to shareholders with a rare tax-exempt opportunity. Yes, you heard that right, tax-free. Think of it as a way to minimize double taxation, which is when the government taxes the corporation and then taxes the shareholder when they receive dividends. The CDA helps avoid that on specific types of income, effectively creating a tax advantage pathway for wealth transfer. Consider the CDA as a notional account that's tracked for tax purposes. CDAs grow from tax-free capital gains, dividends from other corporations, and life insurance payouts. Most business owners unknowingly make a simple filing mistake, and when they do, the CRA can strip away their tax-free benefits. I'll show you how to avoid that in just 1 minute. Now, here's how it works practically. A capital dividend account is not a literal bank account. It is a tax-tracked account growing from the capital gains, corporate dividends, and life insurance proceeds. It's essentially a running tally of the tax-free amounts that can be distributed to shareholders. The larger the total, the more wealth you can distribute tax-free. To actually use this balance, you need to file an official election form with the CRA. This election is made using a specific form, the T2054. It's important to file this form correctly and on time to ensure those dividends are truly tax-free. Once it's approved, you can legally distribute dividends from your CDA balance completely tax-free. The timing of the election is important. You must file the T2054 before you pay out the capital dividend. If you pay the dividend first and then file the election, the CRA may refuse the tax-free treatment and assess penalties. It's always a good idea to wait for confirmation from the CRA that your election has been accepted before distributing the funds. Maintaining accurate records of your capital dividend account balance is also essential. This includes tracking all qualifying transactions and keeping copies, all filings with the CRA. Good record keeping will help you avoid disputes with the CRA and ensure that you can accurately calculate your CDA balance when you're ready to distribute funds. So, what exactly adds to your capital dividend account balance? Let's break down the main components in more detail. First, the non-taxable portion of capital gains. This is currently 50% of the capital gain. This means that if your corporation sells an asset for more than its original cost, a portion of that gain can be added to your CDA. Second, capital dividends received from other corporations. If your corporation owns shares in another private corporation and receives a capital dividend, that dividend can be added to your CDA. Third, life insurance death benefits. This is a big one. The death benefit after subtracting the adjusted cost base, or the ACB, which represents the original value of an asset adjusted for factors like additional investments or withdrawals, is credited to the capital dividend account. This amount is often the largest contributor to the CDA balance for many private corporations. And finally, non-taxable gains from selling eligible capital property. This includes things like goodwill and other intangible assets. Let's look at an example. Let's say your corporation sells a commercial property and realizes a $1 million capital gain. After taxes, $500,000 can be added to your CDA, allowing you to distribute that amount to yourself tax-free. This is a significant tax savings compared to paying regular corporate tax rates on the entire gain. It's also important to remember that capital losses can reduce your CDA balance. This will offset any capital gains you've realized in the past, potentially reducing the amount available for tax-free distribution. Now here's where things get interesting. Corporate-owned life insurance can help you to significantly build up a CDA balance. When a life insurance policy owned by your corporation pays out a death benefit, that death benefit minus the ACB is credited to your CDA, allowing for substantial tax-free dividends. The ACB is essentially the cost of the insurance policy, and it's usually low compared to the death benefit. This is important for estate planning, corporate debt repayment, shareholder buy-sell agreements, and wealth transfer. It allows you to transfer significant wealth to your heirs without incurring a large tax liability. Let's look at another example. Suppose your corporation owns a $3 million life insurance policy on a key shareholder. Upon their passing, a $3 million life insurance payout with a $300,000 ACB creates a $2.7 million CDA credit, fully tax-free. This powerful leverage makes corporate-owned life insurance a cornerstone of effective business planning. So why does a CDA or a capital dividend account matter practically? Mainly, it can help you save a lot of money in estate taxes. Let's explore some strategies to help you do the same. First, shareholder buy-sell agreements. CDA-funded dividends can effectively buy out shares from a deceased shareholder's estate, ensuring smooth business continuity and preventing potential disputes. Next, estate and succession planning. CDA dividends help pass business wealth efficiently to family members or successors, minimizing taxes and maximizing value. Lastly, corporate debt repayment. CDA dividends can repay corporate debt tax-free, improving your cash flow and strengthening your business's financial health. Let's briefly touch on some more advanced strategies and considerations related to the Capital Dividend Account. The CDA can be a valuable tool for funding shareholder buy-sell agreements. These agreements outline what happens to a shareholder's shares in the event of their death or disability. Life insurance funded through the corporation can provide the funds to buy the shares from the deceased shareholder's estate, and the CDA can be used to distribute those funds tax-free. The CDA can also be used to repay corporate debt. If your corporation has outstanding loans, you can use the tax-free funds from the CDA to pay down that debt, freeing up cash flow and improving your corporation's financial position. Cross-purchase agreements are another strategy that can be used to transfer shares efficiently. These agreements involve shareholders purchasing life insurance on each other, and the death benefit can be used to purchase the deceased shareholder's shares. The CDA can then be used to distribute those funds tax-free. Before you attempt a CDA strategy, here's one thing you must do: consult with an expert. Talk to your accountant, financial advisor, and insurance advisor like Dundas Life to develop a plan that maximizes the benefits to the CDA while ensuring you're following all of the CRA's rules. Early planning is key, especially considering the 2017 tax reforms. A good financial team can help you assess your situation, identify potential risks, and develop a strategy that meets your specific needs. Your accountant can help you track your CDA balance and ensure that you're filing the T2054 form correctly. Your financial advisor can help you develop a comprehensive financial plan that incorporates the CDA as part of your overall wealth management strategy. And your insurance broker can help you find the right life insurance policy to maximize your CDA benefits. At Dundas Life, our approach combines life insurance expertise with strategic tax planning. We regularly work alongside accountants and legal professionals to help you maximize your CDA benefits, ensuring your financial plan aligns with your business and personal goals. By the way, if you're finding this information helpful, Give this video a like and subscribe to our channel for more insights on financial planning and insurance. Now let's talk about some potential pitfalls of a capital dividend account. It's not just tax-free dividends. There are some important risks and considerations to keep in mind. First up is CRA compliance. The CRA has strict general anti-avoidance rules, or GAR. Attempting improper use of the CDA can result in significant penalties. You need to be careful and ensure you're following all of the rules. Second is non-resident shareholder. If you have shareholders who are not residents of Canada, they might be subject to a withholding tax on any capital dividends they receive. Many business owners make this costly mistake when dealing with international shareholders. Don't be one of them. Next is election filing timing. This is a big one. The CDA elections must be filed correctly and on time. Incorrect or late filings can result in penalties or lost tax-free dividend opportunities. Crucial to file the T2054 form on time to avoid penalties. And finally, trust structures. Funds passing initially through certain trusts do not qualify for CDA credits. This is a complex area. Many people assume it works, only to find out too late that their CDA benefits are gone. So it's essential to seek professional advice if you're using a trust as a part of your estate plan. The CRA can also invoke the general anti-avoidance rule if they suspect the primary purpose of a transaction is to avoid taxes. This is a broad and powerful rule that can be used to challenge even legitimate CDA distributions if the CRA believes that they are a part of a broader scheme to avoid taxes. Now you know how the capital dividend account can help you unlock tax-free wealth. But here's the key. Most business owners never take full advantage of it. Don't leave money on the table. It's a complex topic, but hopefully this video has provided you with a better understanding of how it works and how it can benefit you. At Dundas Life, we're committed to providing you with the knowledge and resources you need to make informed decisions. We've helped business owners save millions in taxes. Want to see how? Click on the link in the description below to book a free consultation today. If you'd like to learn more about how the CDA can benefit your business and your family, or if you have any questions about life insurance and financial planning, we're here to help. Hit like and subscribe for more insider tax-saving strategies and expert financial insights, so you never miss an opportunity to grow your wealth. Don't forget to leave a comment below with any questions you may have about the CDA or other financial planning topics you'd like us to cover in future videos. We love hearing from you. Thank you for watching. I'm Rozdeba from Dundas Life. We'll see you in the next video.